Today, we're tearing into an expert financial analysis of, well, one of the biggest companies on the entire planet, Apple. We're going to explore how an analyst can look at a company that's firing on all cylinders and still come to a pretty surprising conclusion about its stock. Let's get right into it. Okay, so the whole story kicks off with this number right here, $240. An analyst has put this out as the new fair value estimate for a single share of Apple. Now, what does that mean? Just think of it as the price they believe the company is fundamentally worth based on its future profits, completely separate from all the day-to-day noise of the stock market. And hey, this isn't just some small adjustment. We're talking about a huge 14% jump from the old estimate of $210. A company doesn't get a boost like that unless it's doing something very, very right.
But here's the twist. Even after raising the company's value by a whopping 14%, the analyst's final verdict is that the stock is, well, it's overvalued right now. So how can that be? How can a company be doing so well that its value gets raised, but it's still considered too expensive? That's the big question we're going to answer.
All right, so to really understand this puzzle, first we have to look at the results that got the analysts so excited in the first place. Apple just posted a fantastic quarter that really impressed everybody, even the seasoned pros.
I mean, the sheer strength here is just wow. Revenue hit 102 times billion dollars, up 8%. Gross margins got even bigger, and that all-important services division, it grew by a massive 15%. And on top of all that, Apple is actually forecasting even stronger double-digit growth ahead. These numbers are incredible, especially when you think about all the headwinds like tariffs and issues in China. You'd think numbers like these are a total slam dunk, right? An obvious green light. And yet, this brings us right back to the central conflict. Apple is performing brilliantly, but the analyst still uses the word challenging to describe the stock price. And this really highlights a crucial idea. There's a huge difference between a great company and a great investment at its current price. So, to get a handle on Apple's true long-term value, we need to talk about this key concept the analyst brings up again and again. It's called an economic moat. Okay, picture a medieval castle, right? The moat was that big ditch of water that protected it from attackers. Well, in business, an economic moat is basically the same idea. It's a sustainable advantage that protects a company's profits from all the competitors trying to storm the castle. It's the secret sauce for why some companies can just keep winning, year after year. And this right here shows you exactly how the analyst sees Apple. They don't just give it any old moat, they give it a wide moat. That's the strongest rating you can get. This fortress icon, it's the perfect way to picture the analyst's belief in Apple's deep, powerful structural advantages. So, what is this fortress actually built from? Well, according to the analysts, there are three key things that make up Apple's wide economic moat. First, high switching costs. Second, some really powerful intangible assets. And third, a super strong network effect. Let's break down exactly what each of those means. All right, we're now heading inside the fortress. We're going to explore the bull say case. Basically, we're looking at the pillars that make Apple so incredibly dominant and profitable. The first pillar is what we call switching costs. It's all about making it a real pain for you to leave. Think about that walled garden you always hear about. If you ditch your iPhone for an Android, you lose the blue bubbles in iMessage, you lose FaceTime. Your Mac, iPad, and your watch, they just don't talk to each other as smoothly anymore. Even your AirPods aren't as slick to connect. So to leave is to actively choose a less convenient life. And let's be honest, most people just aren't going to do that. Pillar number 2 is intangible assets. This is all the stuff that competitors just can't buy or copy. It's Apple's amazing design, sure, but the real kicker is their decision to design their own computer chips. The A-series chips in iPhones and the M-series in Macs let Apple do things nobody else can. They can fine-tune performance, get amazing battery life, and bake in security features right at the hardware level, like the secure enclave that protects your fingerprint and face data. That deep, deep integration of hardware and software, it's a massive, massive advantage. And the third pillar is the network effect. Oh, this one is powerful. It's a cycle that just keeps feeding itself. You see, Apple has a huge user base, and they tend to have money to spend. That attracts the best app developers because they want to make money. That huge selection of awesome apps then attracts even more customers to buy iPhones and iPads. More users means more developers, which means better apps, which means more users. You see, it just keeps spiraling upwards. So, Apple has built this incredible fortress. It seems impenetrable. But, no fortress is ever completely safe. So now we have to look at the bear say case, the potential storm clouds on the horizon that could threaten Apple's reign.
This quote from the analyst really gets to the heart of the biggest risk. At the end of the day, what does Apple sell? Premium gadgets. That means its fortunes are tied to how much people are willing to spend. And more importantly, it means it's always at risk of being disrupted by the next big thing, just like the iPhone completely disrupted BlackBerry all those years ago.
The analyst breaks this down into three main worries. First, geopolitical risk. Let's face it, their supply chain is super dependent on China and Taiwan. Second, regulatory scrutiny. Governments, especially in the US and Europe, are taking a hard look at the App Store and that walled garden, and they could force Apple to make changes. And finally, that disruption risk we just talked about, the constant threat that some new technology comes along and makes the iPhone, well, not so important anymore.
Okay, so we've seen the incredible strengths of the fortress, and we've looked at the potential cracks in its walls. Now, let's bring it all back to that first question about price. Because remember, a great company isn't always a great investment.
And this slide really says it all. The blue line, that's the stock's actual price on the market. The orange line is the analyst's fair value estimate of $240. And you can see it plain as day. The market price is way above what the analyst thinks the company is fundamentally worth.
We can actually boil that whole chart down to just one number, 1.13. This is Apple's price to fair value estimate ratio. Now, a number by itself doesn't tell you much, right? You need context. So check this out. When you put Apple's 1.13 next to its big tech rivals like Alphabet at 0.83 and Microsoft at 0.88, well, a pretty clear picture starts to emerge. So, what does this ratio even mean? It's pretty simple. A ratio of exactly 1 means a stock is trading right at its fair value. Anything below 1, like Google and Microsoft, suggests it might be a bargain. And a ratio above 1, like Apple's 1.13, well, that means the stock is trading at a premium, or, in this analyst's opinion, that it's overvalued.
And that leaves us with this final thought. Nobody is doubting that Apple has built one of the most powerful economic fortresses in the history of business. That moat is wide, it's deep, it's real. But, according to this analysis, the market already knows all of this. It might have priced in not just today's success, but years and years of future success too. Which poses the ultimate question for any investor. Has the price of admission to get inside this fortress just become too high?